SpaceX is about to go public. That's not a secret anymore. By the time you're watching this, the IPO is probably close enough that you've heard about it somewhere. A news headline, a podcast, a friend at work who suddenly has opinions about rockets. And here's what I want to tell you right up front. Almost everything you're hearing is about the wrong thing. The conversation is focused almost entirely on the valuation at the IPO price and whether it's going to pop or crash on day one. That's a reasonable question. It's just not the most important question. And in this video, I want to try to ask the right ones. Let me tell you what I actually care about when I look at a company before I even think about whether it's a good investment. I want to understand what it does, who's paying for it, whether those customers are going to keep paying for it, and whether the business has any structural advantages that would make it hard for a competitor to come in and take those customers away. Boring stuff, really, but it's the boring stuff that tends to matter most, especially when everyone around you is getting excited. So let's start with what SpaceX actually is, because there's a good chance you only know part of the story. Most people think of SpaceX as a rocket company. Elon Musk, NASA contracts, astronauts, the occasional dramatic explosion that turns into a successful landing 3 attempts later. And that's all real. SpaceX does launch rockets, and they become extraordinarily good at it. The key innovation, and I want to say this plainly because the financial press sometimes makes it sound more complicated than it is that they figured out how to land the rockets after they launched them and use them again. Before SpaceX did this, every rocket that went to space was essentially a single-use item. You'd spend hundreds of millions of dollars building a rocket, light it on fire, and then watch it fall into the ocean. SpaceX changed that. They land the rockets back on the launch pad, inspect them, refuel them, and fly them again. As of this year, they've reflown some of those boosters more than 20 times. And what that means in practical terms is that the cost of getting something into space has dropped by something like 90% compared to where it was 15 years ago. That's not a marginal improvement. That's a transformation. But here's the part that doesn't get nearly enough attention. The rocket business, as impressive as it is now the smaller part of what SpaceX does. The bigger part, the part that's growing faster than almost anything I've seen in a long time, is called Starlink. Starlink is SpaceX's satellite internet service. The way it works is fairly simple to explain. SpaceX has been launching thousands of small satellites into low Earth orbit. Because they're low, much closer to the ground than traditional communication satellites, which sit about 22,000 miles up, the signal doesn't have to travel as far, which means you get internet speeds that feel fast and normal, not like you're talking to a satellite from the 1990s. You put a small dish on your roof, it connects to whichever satellite is overhead, and you get broadband internet, basically anywhere on Earth. Mountains, oceans, remote farmland, rural Pakistan, it doesn't matter. If you're outside, you can probably get Starlink. In 2023, Starlink had about 2 million subscribers. Today, that number is around 10 million. In less than 3 years, they grew their customer base 5 times over. And before you say, well, that's a small number compared to Comcast or AT&T, I want you to think about where those new customers are coming from. They're not coming from cities where there are already 5 cable options and fiber optic lines running under the street. They're coming from places that have never had good internet before. They're coming from countries that don't have the infrastructure to lay fiber across thousands of miles of terrain. They're coming from ships and planes and military operations. The market Starlink is going after isn't the one where everyone already has service. It's the one that everyone else gave up on. Right now, Starlink accounts for 61% of SpaceX's total revenue. The rocket business, the thing most people associate with the company, is less than 40%. I think that surprises a lot of people. It surprised me a little when I first saw the numbers clearly laid out. Now, I want to stop for a moment and tell you something I always try to tell people. I could be wrong about all of this. Companies that grow fast can also stumble fast. Satellite internet is not without its challenges. There are weather effects, there are regulatory hurdles in different countries, and there are real questions about what happens when competing networks from other companies start to scale up. Amazon has a similar project in the works. The competition is not zero. I'm not going to pretend otherwise. But I will say that the structural cost advantage SpaceX has from being able to launch their own satellites on their own rockets at their own dramatically reduced cost is significant. Every competitor who wants to build a satellite network has to pay someone, probably SpaceX, to get their satellites into orbit. SpaceX is essentially selling picks and shovels while also running the best mine in town. Let me talk about the filing that SpaceX submitted to the US government, because there's a number in there that I think is worth understanding carefully. SpaceX told regulators that they're targeting a total addressable market of $28.5 trillion. Now, let me put that number in context, because on its own, it sounds like something a marketer made up. The entire U.S. economy, everything produced and sold in this country in a year, is about $28 trillion. So SpaceX is claiming their potential market is roughly the size of the U.S. economy. That's an extraordinary claim. Is it true? Here's how they break it down. And I think the breakdown is more instructive than the total. About $370 billion comes from the core space business. Launches, satellites, the rocket stuff. About $1.5 trillion comes from connectivity, which is Starlink, broadband internet service. And then a newer piece they're calling Starlink Mobile, which works directly with the phone in your pocket. No dish required, and which is already being tested in partnership with T-Mobile. And then there's the number that made me sit back and think for a while, $26 trillion attributed to artificial intelligence. Let me explain why SpaceX is in the AI business, because it's not immediately obvious why a rocket company has anything to do with that. SpaceX owns the social media platform X, formerly known as Twitter, and through that, a significant position in the AI company xAI, which makes a product called Grok. But more importantly than that, SpaceX is developing something it calls the AI-5 chip, their own custom artificial intelligence processor, and they have ambitions to build data centers, enormous ones. And this is where it gets genuinely interesting. Data centers, the giant warehouses full of computer servers that run everything from ChatGPT to Netflix recommendations, have two enormous problems. The first is energy. They require staggering amounts of electricity, and the power grid in most countries is struggling to keep up. The second is heat. Computer chips generate tremendous amounts of heat, and keeping them cool requires water, air conditioning systems the size of office buildings, and more electricity. These are not small problems. They are, at this moment, genuinely limiting how fast AI can grow. SpaceX's filing mentions the possibility of space-based data centers, and before you laugh, think about what space actually offers. It's minus 270 degrees Celsius out there. You don't need cooling systems. The sun shines 24 hours a day with no clouds and no atmosphere getting in the way, so solar power is dramatically more efficient. And if you need to get equipment up there, SpaceX is the only company in the world that can do it cheaply. I want to be honest with you, this is not something SpaceX is doing today. It is something they have described as a goal in a legal document filed with the federal government, which means they take it seriously enough to put it in writing where lying would be a crime. Whether they can actually execute on it is a different question, and I genuinely don't know the answer. But I don't think Wall Street is pricing it in at all, and that asymmetry is worth paying attention to. Now let me talk about the IPO mechanics, because this is where a lot of regular investors get hurt, and I don't want that to happen to you. When a company goes public, that is, when it sells shares to the general public for the first time, there's a period afterward called the lockup period. During this time, the people who owned the company before the IPO are not allowed to sell their shares. The typical lockup is about 6 months. The reason this matters is that after the lockup expires, a lot of IPOs have seen their stock price fall sharply, sometimes dramatically. Think about Uber, which went public in 2019 at around $45 a share and then watched its stock collapse after lockup. Or Rivian, the electric truck company, which debuted around $78 and lost 90% of its value within 18 months. The pattern is familiar. Company goes public at a high price. Insider selling begins after lockup. Stock falls. Regular investors who bought at or near the IPO price get hurt. Is SpaceX going to follow that pattern? I genuinely don't know, but I think there are a few reasons to believe the situation might be different, and they're worth understanding. The first reason is taxes. The early investors in SpaceX bought their shares 20 years ago for very little. Today, those shares are worth enormous amounts of money. If they sell, the U.S. government is going to take a large bite. Federal capital gains tax is 20%, add state taxes minus California, where many of them live, is another 13%, and you're looking at roughly a third of your money going to the IRS the moment you sell. People with that kind of money are very good at finding alternatives to paying taxes, and the alternative they typically use is called a securities-backed line of credit. In plain English, they walk into a bank, say they have $100 million of SpaceX stock, and the bank lends them $15 or $20 million in cash against that stock as collateral. No tax. The interest is tax deductible, and they still own the stock. Elon Musk has been doing this with Tesla shares for years, so have Jeff Bezos and most other billionaires with large concentrated positions. They don't sell, they borrow. And as long as that option exists, the pressure to sell and crash the stock is meaningfully reduced. The second reason is something that happened quietly earlier this year that I think most retail investors haven't heard about. The NASDAQ, the exchange where SpaceX is expected to list, changed its rules about how new companies get added to. the major indexes. Specifically, they changed the rules around the NASDAQ 100, which is the index of the 100 largest companies on that exchange. And this matters enormously because there are trillions of dollars of index funds and retirement accounts that automatically buy every stock in the NASDAQ 100. The moment a company joins the index, all of those funds have to buy it. They have no choice. It's mechanical. The old rule said you had to wait 3 months after your IPO before you could be added to the index. The new rules say 15 days. The old rules also said that a certain percentage of your shares had to be publicly traded, what's called the float, before you'd be eligible. That rule was removed, and there's a third change that seems almost designed for SpaceX specifically. If your float, the percentage of shares actually available to trade, is below 20%, NASDAQ will now give your stock 3 times the normal weighting in the index. This means funds have to buy 3 times as much as they otherwise would. Think about what that means in practice. SpaceX is going public with a relatively small portion of its shares actually available to trade. Most of the company is staying with Musk and the original investors who have no intention of selling. So the supply of SpaceX stock in the open market is small, and within 15 days of the IPO, hundreds of billions of dollars in passive index money are mechanically required to start buying. Small supply, large mandatory demand. I'm not a mathematician, but I know which direction that tends to push prices. Now I want to give you the part where I'm genuinely uncertain, because I think you deserve the honest version of this analysis, not just the bullish case. Elon Musk's SpaceX, the company's extraordinary track record, the reusable rockets, Starlink's growth, the ambitions around AI and Mars are inseparable from his specific way of operating. He sets impossible deadlines, attracts extraordinarily talented engineers who want to work on impossible things, and manages, through a combination of technical genius and relentless pressure. That formula has worked better than almost anyone predicted, but it is also a formula that depends very specifically on one person. If something changes, if Musk's attention is consumed by his other companies, or if his relationship with the political environment shifts in ways that affect SpaceX's government contracts, or if something happens to him personally, the risk to the business is real and significant. That's not a comfortable thing to say, but it's true, and you should factor it into how you think about position sizing. There's also the question of valuation. SpaceX is expected to list at somewhere around $1.75 trillion. To put that in context, Apple, the most valuable company in American history for most of the last decade, currently worth something in the neighborhood of $3 trillion. SpaceX, at its IPO, would be worth more than most of the largest companies on Earth. That's not automatically wrong. Markets sometimes price in future growth. And there's a reasonable argument that if Starlink keeps growing and the AI ambitions even partially materialize, the business could be worth much more. But it also means there's not a lot of room for things to go badly without the stock. Feeling it, high expectations are both an engine and a liability. Let me tell you about Elon Musk's compensation structure, because I think it reveals something about how he's thinking about the next 10 years. His pay package is tied to a series of milestones. He gets a meaningful portion of his compensation only when SpaceX reaches a market capitalization of $6.5 trillion, and then progressively more at milestones beyond that. The structure is designed so that the bulk of his compensation doesn't unlock unless the company is worth more than $7 trillion. The expected IPO price puts the company at about $1.75 trillion. For Musk to collect the majority of what his package promises, SpaceX needs to be worth 4 to 5 times what it's worth at IPO. That is not a company betting on modest, predictable growth. That is someone betting on something extraordinary happening. Does that mean it will? No. History is full of companies that have brilliant founders with audacious compensation packages tied to goals that turned out to be aspirational rather than operational. But I'll tell you this much. It means Musk is not going to be taking his eye off this ball. He has more personal financial incentive to make SpaceX succeed than almost any CEO in history, and he has voluntarily agreed to lock himself up, meaning he can't sell his shares. For a full year after the IPO, 366 days, the guy who controls 85% of the voting power of the company has essentially said in a legal document that he's not going anywhere. Now, let me talk about how a regular person might think about participating in this. I want to be careful here because I'm not a financial advisor and I'm not going to tell you what to buy. What I can do is share how I think through the options and what the trade-offs look like. The most direct way to participate is to buy the IPO shares themselves. Most retail brokerage platforms, places like Schwab, Robinhood, Fidelity, and others, allow customers to request an allocation of IPO shares before the stock starts trading. If you're interested, you'd want to register your interest early rather than waiting until the last day. You likely won't get as many shares as you request. That's normal. IPO demand from retail investors is typically much higher than supply. The upside of getting in at the IPO price is that if the stock moves up significantly when trading begins, you benefit. The downside is that IPO pricing is genuinely hard to evaluate, and there's real risk that the initial enthusiasm is priced in before regular investors can act. The second option, and I think this is actually the most sensible one for most people, is simply to own an index fund that tracks the NASDAQ. The most common one is the QQQ, which tracks the NASDAQ 100. When SpaceX joins that index, and based on the new rules, it will happen within about 15 days of the IPO, every QQQ holder automatically gets exposure to SpaceX without doing anything. The fund rebalances mechanically, and given the 3 times weighting that NASDAQ has indicated will apply because of the small float, the exposure could be meaningful. You don't have to time anything. You don't have to watch a screen. You just own the index. This is probably the least exciting sounding option and very possibly the best one for most people. There are also the companies in the SpaceX supply chain, the firms that make components, chips, launch services, and infrastructure that SpaceX depends on. These are often called picks and shovels plays. The idea being that when there's a gold rush, you don't have to bet on which miner strikes it rich if you're selling shovels to all of them. Small companies in the satellite and space sector have already moved significantly in anticipation of the IPO, which means the easy money in some of them may already be made. I'd be careful here. Small companies can move fast in both directions, and buying something that is already tripled is a very different risk proposition than buying it before it moves. If you're looking at these, I'd want to understand what exactly the company makes, how dependent they are on SpaceX specifically, and whether the current price reflects realistic expectations or pure enthusiasm. The chip supply chain is a different story. Taiwan Semiconductor, known by its ticker TSMC, is the company that manufactures nearly every advanced semiconductor in the world. SpaceX's AI chip will go through their foundry. TSMC has been growing steadily, serves an enormous base of customers well beyond SpaceX, and has a genuine competitive moat. There is no realistic near-term alternative to what they do at the cutting edge. Intel is a more complicated story. It's been a difficult decade for Intel, and the stock has reflected that. But the shift toward AI that actually does tasks rather than just answering questions, what the industry calls agentic AI, has started to increase demand for the kind of processors Intel specializes in. There's an argument that the market has given up on Intel too completely. I could be wrong about that. Intel has disappointed a lot of patient investors before, but the setup is interesting. There's a company called Amkor Technology that does something very specific and very important: chip packaging. This is the step where a finished silicon chip gets assembled into the physical package that can actually be mounted on a circuit board and put in a device. It sounds unglamorous, and it is, which is probably why it doesn't get a lot of attention. But Amkor recently built a new facility about 7 miles from TSMC's factory in Arizona. That's not a coincidence. That's what a supply chain reorganizing itself looks like. If TSMC is making chips and Amkor is packaging them, and both are located in Arizona, there's a reasonable inference that a lot of that output is going to end up in American-made devices for American companies, SpaceX included. I want to close with something that I think gets lost in all of the noise around events like this. The SpaceX IPO is genuinely significant. The company has accomplished things that most serious observers thought were impossible 15 years ago. The business is real, the revenue is growing, and the market they're addressing, people in places without reliable internet access, is enormous and largely untapped. At the same time, excitement is not a substitute for analysis. Buying something because everyone is talking about it, because it feels important, because you don't want to miss out, those are the worst reasons to buy anything. And they're the reasons most retail investors get hurt on exactly the kinds of events that should be opportunities. Here's a question I'd ask yourself before you do anything. Do you understand what you're buying? Not in the sense of knowing what SpaceX does. You've probably known that for years. I mean, do you understand the specific piece of the business you'd be owning, the price you'd be paying? What would have to happen for that price to look cheap in 5 years? And what would have to happen for it to look expensive? If you can answer those questions, you're investing. If you can't, you're speculating. Both are legal. Only one of them is a strategy. My daughter is still using Starlink. She loves it. Last time I called her, she mentioned she'd been telling her neighbors about it. A couple of them signed up. That's the kind of thing I pay attention to. Not because it tells me exactly what SpaceX stock is going to do. It doesn't. But because it tells me something real is happening in the world. And real things happening in the world have a way of showing up in the financials eventually. The rest is just figuring out whether the price you're paying today leaves you room to be right. I don't know if SpaceX is going to be a $10 trillion company. I don't know if it's going to be a $3 trillion company. I do know that it's already changed the economics of getting things into space, that it's already selling internet service to 10 million paying customers and growing, and that the man running it has structured his own compensation so that he doesn't get paid unless it becomes extraordinary. And that's more than I can say for most companies. Whether that's enough for you is a decision only you can make, but at least now you have something closer to the full picture. And that, I think, is where every good investment starts.